Hello guys, welcome back to another section. It's day 2 of the beginners class, and today we are going to be talking about trading terminology. So there are some terminology in Forex, right? Some um, common terminology used in Forex. So I'm going to start by explaining what pips is, right? The first on the list is pips, right? Pips, right? So what's pip? A pip is the smallest price move that a given exchange rate can make. For most currency pairs, one pip is 0.0001. So, for example, if Euro USD moves from 1.2000 to 1.2001, so that's to say Euro USD has moved from 1.0000 to 1.001, which is just one pip, right? So what am I trying to say? This pip is the movement of price. It's used to calculate the movement of price, right? Like, just for example, like we humans, if you want to calculate our movements, we calculate it by steps, right? I can move from here to another area. If I want to calculate the movement, I calculate it with my steps, right? So that's what pips is in terms of the forex trading. In market, you calculate the price movement by pips, right? So let's go to the next thing. All right, on to the next terminology, which is spread. Spread. So what's spread? Spread is the difference between the bid and the ask price, right? So what is bid and what is ask? What's bid and what's ask? The bid price is the price at which you can sell the base currency, right? And the ask price is the price at which you can buy it. So in the first section, I explained currency pair, and I said, for instance, Euro USD. This pair right here now, which I say the first is the base currency. The first is the base currency, and the second is the quote currency, right? The first is the base currency, and the second is the quote currency. So right now, the bid price, the bid price is the price at which you can sell the base currency. The price at which you can sell this currency, which is the euro, right? It's called the bid price. And the price at which you can buy this same currency, euro, which is the base currency, is called the ask price, right? So that's what we call bid and ask. So now, for you to understand what spread is the difference between these two, the bid and the ask. The difference between the bid and the ask is called spread. In other words, spread is the difference between two prices, right? For instance, if you're a trader, probably okay, you do sell stuff. Let me say maybe you sell toothbrush, right? For you to sell toothbrush, you have to go and get it from the market, which is probably the wholesale shop, right? And that price you're going to get it at, that's not the price you're going to sell. I don't know if you're understanding. That price you're going to get that particular product at, that's not the price you're going to sell at, right? So the difference between the price you got the toothbrush, right? The difference between the price you got the toothbrush and the price you sell the toothbrush, the difference between that price is called the spread. The difference is called the spread. So let me give an example, right? So for instance, you buy toothbrush for $12, right? And you come back to sell that toothbrush for $14, right? So what's the difference between these two prices? 14 minus 12 is equals to $2. So the difference between these two prices right here is $2. This $2 is called the spread. This $2 is called the spread. Same with the forex market, right? Same with the forex market. That's spread. That's spread. I hope you guys understand my explanation, because that's the simplest way I can explain that, right? For you guys to understand. So that's spread. All right. Another terminology is the lot size. Lot size, right? What's lot size? A lot is a standardized quantity of currency being traded. A lot is a standardized quantity of currency being traded. So we have different types of lot size, right? We have like three types of lot size, which is the standard, mini, and micro. These are the types of lot size, right? On which the standard lot is equals to 100,000 units, while the mini is equals to 10,000 units. 10,000 units, and the micro is equals to 1,000 units. All right, this lot size are used to measure. They're used to measure the quantity of trade. How would I explain this? Okay, so for instance, this lot size determine the amount of profit you make or the amount of loss you make, right? The higher the lot size, the higher profit you make or the higher loss you make. The lower the lot size, the lower profit you make or the lower loss you make, right? It's just used to measure the size. It's used to measure the quantity of trade you want to enter, right? So the higher it is, the higher the lot size, the higher profit or loss you make, and the lower profit or loss you make. So the highest one is the standard, followed by the mini, and followed by the micro lot size, right? All right, the next on the list is leverage, right? Leverage. I'm going to be explaining what leverage is. Leverage. Leverage. So what's leverage? Leverage allows traders to control a large position with small amounts of capital, right? For instance, with 100 ratio 1 leverage, you can control $100,000 with just $1,000. So, for instance, if you're having an account balance of probably $1,000, right? For you to control a larger funds, right? Then your broker will give you leverage. Some broker give different types of leverage. It's up to you to choose which one is suitable for you, right? So you can use the leverage of 100 ratio 1, which is this your $1,000 capital multiplied by 100, which will give you $100,000, which will give you $100,000. With your $1,000 account, you can control funds of $100,000. Not that the money will be physical in your account, but it gives you leverage advantage to make the kind of money you can use this type of account to make. I don't know if you understand what I'm trying to say. If you have $1,000, right? If you can make probably just $500 with this, if you can make just $500 with this $1,000, but if you use this leverage, you can be able to make $5,000, or I think $50,000 with this small account. You can be able to make $50,000 because of your leverage. That's what leverage does. All right, the next terminology here is margin, right? Margin. So what's margin? What's margin? Margin is the amount of capital required to open a leverage position, right? I just explained what leverage is. So now for you to open a leverage position, you require a margin. Your broker will require a certain percent margin from you, right? What is this margin? The margin is the amount of capital required to open a leverage, which is your own capital. So for instance, you want to control $100,000, right? When you're not having up to $100,000, you're not having up to $100,000. What you do is you need leverage, right? You need leverage, and you need 1% of this $100,000 in your trading account for you to control this kind of money, which is 1% of this is $1,000, right? So your broker require you to deposit Your broker require you to deposit $1,000 for you to be able to control this kind of money. This $1,000 you are depositing is the percent which your broker requires, which is the margin. That's the margin, right? That's the margin required for you to deposit to be able to control this kind of amount. Still on the trading terminologies. Right now, I'm going to be talking about other types, right? We have different types of order. There are different types of order. One is the market order. Two, limit order. Three, stop loss order. And four, we have take profit order. All right, these are the types of order we have, right? Right now, I'm going to start by explaining each of them. All right. So the market order to buy or sell at the current price, right? I'm talking about this, the first one. This is the order to buy at a particular price, the current price. I mean to say, the current price of the market. This order is used to execute instantly. Just for instance, if you want to buy or sell, you buy at that current price of the market. Why the limit order? Why the limit order is to buy or sell at a specified price, right? A specified price, probably a better price based on your own satisfaction or based on your own analysis, right? So this first one is the instant execution, buying at a particular price, like instantly at the current price. Why this one? You set your order at a particular area and price go to that area to trigger you in, right? That's the limit order. It's also known as pending order because it's going to be pending depending on when price reach that area you set your order. So now the stop loss order. This is the order to limit losses by closing the position at a predetermined price, right? So this stop loss order is used to cut your losses short. For instance, if you're in a buy position and that buy position is going against you, you set a stop loss order at a particular price you want price to stop you at. Once price get to that area, your order or your positions are being stopped automatically, right? Now this is the take profit order. The take profit order is to close a position when a certain profit level is reached. When a certain profit level is reached. So for instance, if you're in any position and that position is running in profit, you set the order at a particular area so that when the price reaches that area, your profits are closed automatically, right? You don't need to be on chart waiting for you to close. You set this and they are closed automatically. So that's it for the orders, the types of order, right? Moving to the next topic, choosing a broker. A broker. So what's a broker? Broker is the company that you can deposit your money to trade, right? They provide the liquidity in the market. Like they are just like the middleman between you and the market. So we have different types of broker. The broker types. We have the market makers. The makers, they provide liquidity by quoting both a buy and sell price. They may act as the counterparty to trades. We have the ECN broker. ECN broker, electronic communication network brokers. ECN, that's the full meaning, electronic communication network. All right. The ECN brokers connect traders directly to the interbank market, offering lower spread but charging commissions. We have the regulatory bodies. The regulatory bodies ensures brokers adhere to specific standards to protect traders, e.g., FCA in the UK, NFA in the US, ASIC in Australia, right? And so on and so forth. So the criteria for choosing a broker, what you are going to check if you want to choose a broker, you check for spread and commission. Look for brokers with competitive spread and transparent commission structure, right? I talked about spread, and you understand what spread is, right? The difference between the bid and the ask. So some broker has a big spread. They have bigger spread, and some have tighter spread, right? So you can see some broker spread 0.001, 0.003, or 0.005, while some broker is even up to $1. And also it depends on the pair you are trading. All pairs has different spread. So for you to choose a good broker needs to has um a good broker needs to have tight spread, right? Tight spread and a low commission. So those are the things you check for while choosing a broker. All right. Trading platforms. Choose broker that offer robust user-friendly platforms with necessary tools and features. A broker that has customer support. Ensure that the broker provide accessible support and educational resources, right? A broker that can open a demo account, all right, because a demo account allows traders to practice without financial risks using virtual funds to gain experience in executing trades. So those are the things to check out for while choosing a broker. So um, now I'm going to leave a link. I'm going to leave a link down for you guys to register, right? Because currently we have few brokers with low spread and lower commission, with tight spread and lower commission. So currently I'm using two brokers, but I'm going to be leaving the link to one, right, which I'm partnering with for this class, right? So they have zero spread account and they have a very low commission, and their minimum deposit is $5, right? Also, the minimum withdrawal is $5. So as you can see, if you make if you deposit $5 and you have up to $5 in your account, you can withdraw the $5 as long as it's up to $5. That's the minimum withdrawal. So I'm going to leave the link for you guys to register, and I'm also going to leave a video on how to register with a broker, how to create a demo account, and also I'm still going to show you how to verify your account so that it will be set for trading real account. So that is that for that. All right, the broker I use is HFM. That's the broker I use. So I'm just going to make a video now on how to sign up with HFM. All right, so guys, I already have the link copied, right? So I'm just going to paste it right here and hit enter. So if you want to sign up, I'm dropping the link in the group. So what you just do is click on the link and it will take you directly to this page. All right. So once you're in this page, you click on register. Right here. You click on register. And as you can see, this is a sign up form, individual, right? That's because it's a personal account, so you're choosing individual. If you are signing up for a company or a joint account, you can choose corporate or a joint account. But since you're the one signing up just for yourself, you choose individual, right? Then you select your country, the country where you're from, which is Nigeria, because everybody here is from Nigeria. You put your email address and password, right? Password. Then you hit register. Simple as that, right? So once you hit register, then there are some other form or details you need to fill in, right? The broker will ask for some personal details, so you need to fill those details in. I don't want to sign up again because I already have an account, and my account is verified already. So once you fill in your details, if you're having any issue, you can hit me up. I'm going to show you how to go about it through the verification process and everything you need to do. So guys, this is just it.